Share Podcast with our host, Ed Lyon. Ed, I am Happy New Year to you. And now we have to start thinking about 2026 taxes, not 2025, which we're all going to be filing in April and we're extending to May. We're going to focus our attention on 2026 taxes, which means they'll be April of 2027. Is that correct?
April 15th of 2027, or you can extend them all the way to October of 2027. That sounds like it's a long way away, but it is not. It is not. And the choices that you start making now in January of 2026 can have a profound impact on the size of the check that you write to the IRS next year. I'm just fooling with you because the IRS doesn't accept checks anymore. That's a new thing as of October 1st of last year. You must wire the money. You must send it in online. They don't take a paper check anymore.
Oh, wow. I didn't even know that. That's interesting.
Yeah. So 2026 planning starts not with tax, but it starts with your goals. It starts with what you want to accomplish. Remember, my job is not to help people pay less tax. My job is to help people reach their financial goals with a minimum of interference from tax. So I try and pull taxes out of the challenge of saving for retirement, or leaving a charitable legacy, or growing your business, or running a successful trading account. Whatever it is that you do, my job is to help you do it more tax efficiently. So it starts with whatever your financial goals are for the year, whatever your financial New Year's resolutions are. I know everybody says they're going to lose weight, they join a gym, and they start trying to cancel their gym membership sometime in February, when they give up trying to cancel the gym membership when ice cream season rolls around in the spring. So good for them. But the financial goals, and they can be, people have different goals. Some people, they're small, discrete goals, like I was going to say balance my checkbook every month. Nobody balances a checkbook anymore. I'm going to be better with my accounting. I'm not going to let my receipts pile up for 4 months before I give them to my bookkeeper to sort out. So they're the low-level tactical choices you can make. But what I'm really interested in are the strategic choices. Is your business doing well? Great. Do you want to coast? That's fine for some people in some businesses. Do you want to grow your business? Do you want to add a new business? Do you want to add a new kind of investment? Do you want to buy real estate for the first time? Do you want to buy crypto for the first time? Crypto has not gotten a lot of respect from the mainstream Wall environment, but Wall Street banks are now starting to recommend that their clients keep maybe 2 to 4% of their portfolio in crypto. That's going to be huge. That's going to be huge. President Trump has proposed allowing 401k owners to invest their 401k assets in private equity. If we see people moving money into private equity, that's going to mean they're moving out of public equity, and stock prices overall will fall. So we've got a lot going on, and the decision-making process starts with what are your overall financial goals. That's easier than diving into taxes, I think, because nobody wants to dive details of taxes. They think the details are just too horrible. So the broader financial goals are more important. Are you going to be selling something big this year? If you have rental properties, are you going to sell any of your properties? Are you getting ready to retire and sell your business? If you work for a startup company and you have restricted stock units, is there any chance that those are going to be paid out? I got to know this stuff before the end of the year. And honestly, I should know this stuff in January, February, and March. I shouldn't be waiting until October, November, or God forbid, December to hear this from clients. I was hearing from prospective clients as late as the second half of December. People will call on December 20th and they'll say, Ed, I sold a business, I sold real estate, I made $55 million selling my business. I'm looking at a $15 million tax bill. What can I do? And my answer is, first, we're going to get a flux capacitor and we're going to put it in a DeLorean, right? And Marty McFly is going to take you back to the future so that we can do over all of this. So it doesn't start from a position of taxes. Now, let's talk about the big, beautiful bill and the extension of the Tax Cuts and Jobs Act of 2017. That makes a big difference. So at the beginning of 2025, we all knew that the lower tax rates, the higher standard deductions, and a lot of the rules from 2017 were going to expire. At midnight on December 31st, Like's carriage was going to turn into a pumpkin. And a lot of people in the tax business look at how close the margin was in the House and the Senate. The Republicans with just the barest majority in both houses. And we expected it was going to be a long, bruising fight that probably wouldn't wind up until the very end of the year. The Tax Cuts and Jobs Act itself didn't pass until December 12th. I was personally expecting late December. I expected that Congress would go at some point into early 2026 without fixing things. And that would have meant we're all scrambling with no time. So in the real world, meantime, our crystal balls turned out to be very cloudy. And though the Republicans had a very tight majority, very slim majority in Congress, with some pushing from President Trump, they were able to get the big, beautiful bill passed and signed on July 4th. For planners, that was wonderful. Not necessarily wonderful because you like the bill said, but it was wonderful because it gave us 6 months of certainty to plan. So we all know that 100% bonus depreciation is back, and we've been taking advantage of it since 2025. That's great. We know what the rates are. We know what the standard deductions are. We know, for example, that Section 1202 rules have become more generous. And so we've got lots of opportunity baked in that we're not sitting around waiting until the last minute. That's a big plus. So start out with what are your overall financial goals. Bring your tax planner, your business plan, your financial plan for 2026, and then start talking about the specifics.
And what are you excited about in 2026? It'll be your taxes in 2027. We talked a little bit about the big, beautiful bill, but do you expect the economy to come back a little bit with some of these changes?
So, I know taxes. So I'll go ahead and look into my crystal ball on the economy, but I will warn you up front that my crystal ball is pretty cloudy. I think it's conventional wisdom that there's going to be some kind of a pullback in the stock market at some point in 2026, and there is a lot of speculation that we may be in an AI bubble. And the question will be, A, are we in a bubble? B, does that bubble pop or does it slowly deflate? If it pops, we're in a lot more trouble than if it slowly deflates. If it pops, everyone's without a chair in musical chairs. If it slowly deflates, then it's like a game of musical chairs, and only the people who stick around end up getting hurt. So those are the two big questions. Now, let's talk about what that has to do for taxes. If the market goes down and you are investing in a taxable brokerage account, meaning it's not a regular IRA, it's not a Roth IRA, it's just a plain old brokerage account, conventional wisdom says you don't have to sell unless you need the money. And when markets are down, that's not a great time to sell in most cases. So you want to pay attention to what your investments are doing. But let's talk about an exception to that rule, because with taxes, there's always an exception to the rule. Let's say you've got $100,000 in a pre-tax IRA, and you would love to convert it to a Roth IRA. Well, if you do that today and you convert the $100,000, you're going to owe tax on that $100,000. We have a lot of strategies that we can use to lower the effective tax rate on that conversion. But if August rolls around and the AI bubble bursts and the Magnificent Seven stocks all go down because they're so tied into AI, then maybe your portfolio is worth $60,000. If you converted $100,000 at the beginning of the year and incurred a tax bill based on $100,000, you could be pretty unhappy when that portfolio declines to $60,000. So if you're opportunistic and you believe that you can time the market, there may be some opportunities to do some smart planning there. On the other hand, you're going to have a lot of people moving into alternative investments. So people will move into things like private equity, private credit, real estate, and that may let some of the fizz out of the stock market if you don't have so many dollars chasing so few good stocks. And the way our market is performing right now, if you just own 7 stocks, if you own the Magnificent 7 tech stocks, you're getting rich. If you own the rest of the S&P 500, you're middling along.
It'll be interesting because the AI bubble is going to all depend on regulations in 2026. It's going to depend on a lot of different things. November,
You're an expert on AI. You use it extensively in your business. What do you think? Are we in an AI bubble?
No, I don't think we're in an AI bubble unless there are restrictions. If they start limiting the ability to continue to grow AI. And it all depends on how businesses that implemented it last year spend all this money. If they're happy, if the buyer beware a year later when they've let all these employees go and put these automations together and it was an absolute fiasco.
Right.
That could be the end. I think real estate, if I was predicting next year, it would be a real estate bubble before an AI bubble. The real estate hits another crash. I don't know.
No, and that's a perfectly legitimate view as well. We don't know if the Fed is going to lower rates again in 2026. I hear anywhere from 2 to 3/4 of a point seems to be the expectation. And then we've got an election coming up, and that it's always silly season when it's election season. You never know what can happen.
There's so much volatility. So what's the recommendation that basically start on January 1st to really prepare for taxes?
So understand what you're going to do in various scenarios and then have a plan for that scenario so that if it comes to pass, you've got a plan. As one scenario, AI bubble bursts. Second scenario, general stock market decline. Third scenario, inflation goes up for whatever reason. Maybe it's for tariffs, maybe it's just too much money chasing too few goods. So have a scenario for inflation. Have a scenario for a real estate crash, maybe like 2008, maybe not. Real estate is great because you've got so many different local markets. If I were in Austin, Texas, I would be thinking very differently about real estate than I do living in Cincinnati, Ohio. But the idea is you have a plan so that when you see things start to happen, you know what to be looking for, you know what you're going to plan on doing. You don't just wake up, check CNN on your laptop, see the headline says, "World gone to hell in a handbasket." You want to have the plan before you get the headline so that you're not the fifth person on hold calling your broker or calling your tax accountant wondering what to do. But every one of these scenarios leads to tax consequences. Markets going down leads to one consequence. Markets going up leads to another. Interest rates going down leads to one set of consequences. Interest rates going up leads to another set of consequences. And there's that comet, 3I Atlas. We don't know. Is it a comet or is it space aliens? That could change everything.
All right. Last advice for starting 2026. What would you say for taxes? What should people do?
I would say be optimistic. There are two types of people in the world, right? So there are abundance mindset people and there are scarcity mindset people. I am an abundance mindset person. I personally believe that the world is an ocean of money and you can go to it with a teaspoon or you can go to it with a bucket. And if you're going to go to it with a bucket, understand that you're going to have to pay some of your bucket in taxes. That's fine. It will be a lot more than if you're paying part of your teaspoon in taxes, but really just think ahead and have a plan, and that's the most important advice I can give to anyone. I do a lot of hour-long tax presentations before live audiences or on Zoom, and I usually say at the beginning of my presentation that my goal is to change the way you think about taxes. And that's what I've done here at the Lyon Share for as long as we've been hosting this podcast, is I want people to change the way they think about taxes. And for those of you listening in early 2026, the change is don't wait until the fourth quarter to start thinking about taxes.
Exactly. Okay. All right. Again, Ed, appreciate it. Like and subscribe to the podcast and check out Ed Lyon everywhere that he's available. Appreciate it, sir.
Thanks so much.
All right. That was a special simulcast of his show in the Lyon Share Podcast.